Hello, everyone, and welcome to the episode number 12 and first of 2025 of JustDario Cigar Time. So, first of all, I would like to begin wishing everyone Happy New Year and all the best and best of luck for this year to come. A year that definitely began in a way many people were not really mentally ready for. So, isn't it hilarious to think that the previous episode and the last one of 2024, we were discussing about the importance of interest rates and how interest rates would have been a key element. Perhaps maybe they might ended up being the most important element of 2025. And as a matter of fact, the title of the previous episode was 2025, the year that is going to make interest rates great again. So fast forward a few weeks, everyone is freaking out about interest rates. However, not all the situations are the same. Let's start with a easier one to explain, in my personal opinion. My first article of 2025 was about China, and in particular explaining why China government bond yields are going down so much, okay? The great misunderstanding on this topic continuously prompt, mainstream media, of course, most of them in the West, ton of social media to claim, China economy is collapsing, they have deflationary problem, so on and so forth. I don't disagree on the fact that there are problems and areas of the economy that the government is definitely working to fix. However, the movement in interest rate yield in the Chinese bond market is a consequence of both corporates and people piling up on cash. So I don't want to be too simplistic here, but I also don't want to make it too complicated and spend too much time on this, because I wrote quite an extensive article that I will share the link in the comments of this video for everyone that is willing to know more. But logically speaking, when everyone is piling up on cash, people are unwilling to spend, okay, because they're fearful on, the future of the economies in general, not the Chinese economy, the global economies in general. Trump is arriving, there will be tariff, there are geopolitical tension and so on. Plus, you're sitting in a country that is running an incredible trade surplus. So overall, you have all this amount of currency in different shape or form piling up in the system, and in particular in the form of bank deposits. And as I mentioned many times, banks cannot sit idle on all these deposits because they pay an interest, a cost for them, so they need to deploy that cash. And where are banks gonna to deploy that cash if the people with strong credits are unwilling to borrow? The people that would be willing to borrow, like some big companies, differently from what happens in Europe and the US, do not enjoy access to credit in China. You don't want to deploy liquidity abroad because of various reasons. Then you're not left with many alternatives than your own government bonds. So banks, insurances, pension funds that keep seeing these inflows of liquidity from the system, not for money printing, because the People's Bank of China, the Chinese central bank, has stopped doing QE in the Western form a very long time ago, because they realized that all that QE was achieving was to create asset bubbles with little to no benefit for the real economy. And they've been clear about that a long time ago. So this is why Chinese government bond yields keep coming down. Is this a problem? At the moment, no. Okay. And clearly the government doesn't want this to happen and is already working on, solution in order to supply good quality borrower to the system that the bank can lend to, and then avoiding all this piling up of resources in government bond, okay, that stay idle without, much trickle-down effect in the Chinese system, okay? So is it a problem right now? It doesn't mean the economy is crashing. Of course not. I mean, how can an economy crash when its population has an unbelievably high saving rate, when the healthy companies are piling up on cash, especially from exports, okay? And the government already made it very clear that the parts of the economy that are reeling from previous insane bubbles like real estate have been segregated and have been specifically addressed, okay, in order to avoid the consequences to spread out in the system, okay? How can you say that an economy is collapsing when they keep boosting such an incredible amount of growth? I know some people might say, oh, are the data's reliable or whatever? Believe what you want to believe. Okay, this applies to everything. But the reason why Europe and US are freaking out about China and about some specific sectors that are coming up very strong, and it can seriously create damages in the European and US system, in particular, for example, the electric vehicle sector, where electric vehicle cars are being manufactured at incredibly high level of quality, superior than what, for example, is being manufactured in Europe for a fraction of a cost. So this is why, there is so much antagonizing against China. And if China economy was collapsing, things were going bad, would there have been any need for tariffs? Would there be any need for containment on its own economy? Of course not. So this is the first thing I wanted to, make it very clear, presenting to you the facts objectively, because it's frankly disgusting to a certain perspective to read so much ignorance on the matter. And sometimes I'm not even sure it's really ignorance. Maybe it's just willingness to portray a situation in a different way, misrepresenting it on purpose for the whatever benefit of something else. Perhaps to distract people from the fact that things in their own countries are not doing as great as people really claim. Okay? Now, we saw why Chinese yields are going down. But broadly speaking, in the rest of the developed economies, the opposite is happening. Yields are going up. Wow. Everyone is so shocked. Like, literally, 2 weeks ago, Wall Street banks, like Bank of America and others, were predicting 2 to 3 rate cuts for 2025. Few weeks later, into 2025, the very same are saying there might be like 1 or 2. Some of them saying there might not be any rate cut at all in 2025 from the Fed, okay, in a span of few weeks. So what's happening here? This is another topic that, I discussed a lot in the previous podcast and whatever. But there is an element that is being overlooked so far from most of the observators. And the element is that, yes, interest rates are increasing, okay, in an unexpected way. But they're not all increasing in the same way. There is one economy, one financial system that is particularly critical into the grand scheme of things. And this is Japan. Japan hiked rate twice, and their own market almost fell apart, and they had immediately to stop and backtrack. You remember this last year, right? So clearly Japan, because they know that unless cost of funding is virtually free in Japan, most of the borrowers and the zombie companies in their own system, they cannot survive. So Japan, the Bank of Japan, dragged its feet for so long while other central banks were hiking interest rates, even if they didn't do it enough and they stopped too early. Japan kept dragging its feet. And then, when everyone else already started to cut interest rates because even their own economy cannot sustain a certain level of interest rates, even if they should have been much higher because of the inflation, then Japan, not because of real consideration on their own economy, because they wanted to rein in to wild JPY carry trade or whatever, is because, let's be honest, the reason why they hike rates is to try to defend the JPY from devaluation without keep going through selling all the US Treasury reserves, okay? You can make up all the excuses you want, like I'm referring to the chairman of the Bank of Japan. But that's the truth. That's why the BOJ started to increase rates deep down. And now, the incredible thing is that they are pretending that they are still considering that, while it's obvious that they are in no situation to go ahead with another hike, because the overall financial system is already on shaky ground because of this, okay? So the Bank of Japan, I said many times, is in a very inconvenient situation of choosing whether to save their economy or whether to save their financial system, and to a certain extent the global financial system. But the longer they take to take this decision, because this decision will not come without pain, the less chances they have to take a decision in general. And no matter what, they will see their currency greatly devaluating in the future, because that is structure. So in Japan, one very important thing happened. While in the short-term part of the interest rate curve, the Bank of Japan still managed to maintain control of rates, thanks God, and the government representative along with the Bank of Japan, they've still been successful to jawbone everyone that rate hikes are still on the table, so don't mess around with FX, that it's still once again on the verge of 160 against the US dollar. That is where they previously intervened. So despite in this very short element they've been successful, not the same is happening for the long end part of the curve. And people are like, Dario, like the 10-year GDP is at 1.2%. Like the US 10-year treasury is 4.75%. What's the big deal here? The big deal is the rate of change in the interest rates impacts an incredible amount of derivatives, interest rate derivatives, and financial instruments that are tied to this specific rate. And then they were put in place to such a level of degree and leverage that incredibly magnify all of this move to an extent that it's seriously damaging for their own stability. This is what's happening. And in particular, I'm referring about the JPY carry trade. People tend to have overall a very simplistic idea of the JPY carry trade. I've been over and over this so many times, I don't want to spend too much time today on this. But they overlook the fact that people are not simply borrowing JPY at, let's say, 0.5%, and then buying US treasuries in the past at like 2% and just sit there. Of course not. They were using cross-currency swaps to hedge their risk. They were also using other forms of structured derivatives and synthetic form of financing in order to enhance their yield and their pickups, so on and so forth. Okay? So all in all, the rate of change in rates in Japan compared to the rate of change in the US is putting an incredible pressure on this whole system that remained in place for like decades like this. And no one ever believed it could ever change. While now in Japan, you have big pressure to hike wages. You have inflation pressure. You have funding pressure and so on. And then the government and the Bank of Japan still say, oh, we are still fighting deflation. I mean, are you kidding me? Like, are you serious? Like, this is really a sign that they're more and more into a precarious position. And the market is not oblivious to that. And the fact that yield on the longer hand part of the curve are starting to run away, despite the Bank of Japan said before they wouldn't have let that happen. So these are being running away to a higher degree. And those that think that these higher rates will help on the FX are completely wrong. And here I close on Japan and I will move on to UK. Exactly what's happening in the UK is potentially what is going to happen to Japan, okay, in one of the great consequences. UK, it's a system that, my very early followers know very well. I've been warning about since so long. And I find it really entertaining to watch some of these, macro analysts, big commentators, whatever, no one has a clue of what's happening in UK. I mean, people are like, what's going on to rates? Why they're going up so much? People were like completely clueless. Even those that spotted the problem with the JPY carry trade earlier on, they missed completely this situation in UK. So on Friday, the 30-year yield on UK government bond reached pretty much 5.5%. The 10-year yield reached 5%. These levels not only are multi-decades high, but are already beyond the level that triggered the financial crisis more than 1 year ago that impacted insurances and in particular pension funds. Briefly, what happened at that time? At that time happened that all these insurance and pension funds, they keep buying UK government bond, but of course, for many years the yields were so low and they needed much higher return, they entered into derivative transactions called total return swaps with various investment banks in order to boost their yields, right? This created a big problem because the collateral that they put against this position was the very same government bonds they were buying, and they were seeking leverage exposure. So follow me closely here. If the yield goes up, what happens to the bond? The bond value goes down. So the collateral on their bond is going down, okay? But on the other side of the derivatives, how did they manage to boost the yield that they were getting on their portfolios through this total return swap? Putting things simple, what it happened is that effectively they sold call option interest rates. So they cashed in the premium, and with this premium they had the extra yield. Small problem is that if you sell a call option on interest rate, that in jargon is called a ceiling, and interest rates starts go up a lot, then you receive margin call at the very same time your collateral is decreasing in value. This is why the Bank of England intervened, stepping into the market, starting to try to put a brake on this increase in yields, and flooding like this institution at back at the time with liquidity, so they could meet margin call without being stopped out on the position and potentially booking an incredible loss that will ultimately damage the pension system and the insurance system. At that time, everyone blamed Liz Truss, okay? Oh, the yields increased so much because her budget is going to have like massive impact on the finances, on deficit, blah, blah. True. However, the big move in rates didn't happen for that. The initial move in rates, yes. But then the cascade of events that follow, the domino, was actually a result of all this precarious situation between collateral going down in value and the total return swap position losing even more value and be subject to margin call that if unmet, they would have seen the collateral being sold in the market, and that would have added even more pressure on yields because, of course, if they sell bonds, the yield keep going up, and that would have been like an avalanche of selling and a complete mess. That's why the Bank of England stepped in force. They know very well the problem at that time wasn't solved, okay? So if you remember, several weeks ago, they already said, we are going to provide as much liquidity as needed to the financial system, in particular hedge fund manager, pension fund, and insurances, but we will not disclose the name of people that are going to get this bailout cash because we don't want to create panic in the system. Wow. This is incredible, isn't it? So this week, the amount of liquidity borrowed from the short-term repo facility from the BOE broke a new all-time high at 53 billion. This facility is supposed to be a temporary 7-day facility just for small period of stress and liquidity in the system, while in reality, this amount has been growing larger and larger and larger. So, and this effectively is printing liquidity into the system that is not, popping up on Monday and after 7 days, it disappears after these facilities are repaid. No, because this liquidity keeps being rolled and higher and higher and higher, so it becomes sticky. So they're effectively printing new liquidity into the system. They're printing new sterling into the system, and people give gilt as collateral. But following me closely here, when you purchase a government bond, at the very beginning, the government issues government bond and you pay in cash, right? Cash that was already part in the system. If you take that government bond, you pledge it as collateral to the central bank, and the central bank gives you an equivalent amount of cash, do you realize that you have the same bond that exchanged hands twice, but then you have double the amount of cash in the system? And that amount of cash, unbeknownst known to all these observers, is not temporary. It's only temporary on paper, but in reality it's incredibly sticky, because all these like liquidity intervention, they keep piling up left and right. So it shouldn't come as a surprise that yields are going up, but this is not strengthening the British pound at all. On the contrary, is weakening it. And is weakening it because new liquidity is being printed into the system in order to defend the bond market to go out of control and perhaps trigger a series of events that will be more expensive to bail out down the road rather than paying them money not to implode. However, this is simply a can kicking down the road. They're simply delaying the inevitable, okay? So the yields are going up and the currency is not strengthening. Going back to what I said about Japan, that's exactly the same. And I've been writing about this for so long, many, many months ago in 2023 and whatever. People believe that if rates going up, the currency are going to strengthen. It's not the case when you run an incredible amount of debt. When central banks are running an incredible big balance sheet, they cannot get away of their problem without printing money, and the whole system is seeing decreasing marginal effect for the same money provided in order to support the system, to a point that, if you notice, the balance sheet of central banks pretty much is doubling every time they have to do a whole system bailout, right? The last time the Fed balance sheet went up to what, like almost 9 trillion? What's going to be the next time? Like 16, 18 trillion? And then after that, 36 trillion? Of course, it's not possible. It's completely unsustainable. This is why, like, all these people that had so much belief in the power of central banks, that kept following theories that have been put there like many decades ago in a completely different financial system, and that are so outdated and more irrelevant because the financial system changed a lot in the meantime. It became so interconnected, so intricated among global economies that you cannot look at them in isolation anymore. This is why so many people fail to anticipate these events, to anticipate the risk, to manage that beforehand, and then you ultimately have everyone every time scrambling to bail out people. So what is going to be the consequence of these interest rates starting going bananas? Volatility in the FX rate, DXY that now broke 109, and even if it broke 109, we now have commodities that are starting to make a move. The WTI is now above $76 again, while the US dollar is strengthening. All this is incredibly inflationary, okay? However, what happens in an incredible inflationary environment when you start pulling out credit? Because this week, you're seeing the highest decrease of consumer credit made available in the US in a long period of time. So far, people have been able to handle increasing inflation because, in particular in Europe and in US, because they had this crazy access to consumer credit, right? So now you're going to have increasing inflation, people that cannot keep up with it, and this is going to translate in higher cost for corporates with a far lower, if not flat, if not even decreasing, growth in revenues. How is this going to impact stocks? I believe in the very first week of this 2025, a lot of people figured out that if this scenario remains in place, this is not going to be a very good year for stock, because so far stocks enjoyed an increase in revenue mostly as a result of inflation. Just look at Apple, look at Microsoft and whatever, right? But what I'm describing so far is objectively being warned by all the various indicators that are available in the market and I mentioned into the scope. But pay attention to one thing. A lot of money has been printed into the system and it will not, disappear. People say, oh, if stocks crash, it's so disinflationary, it's so deflationary, whatever. Not really, because this time there is so much liquidity sloshing around in the system that a stock crash would not necessarily mean a crash in inflation. In particular, when most of those risky assets are owned by the top 10% of the population. So you will have liquidity come out from stocks and then it will start sloshing around in the system. Where is it going to end? Commodities, crypto, bonds. I'm not that sure, to be fair, because with countries like, spending like drunken sailors, like who the hell wants to invest in bonds, right? With more and more jumpy companies that clearly cannot support this level. With the US Treasury that front-loaded so much of the funding. It's a genius idea of Yellen to do, like Treasury Secretary Yellen said, oh, we are going to run Treasury buybacks. She didn't buy back anything. You do a buyback when the level of debt decreases. She simply took out illiquid long-term treasuries to front-load, to finance this with T-bills. But this created a situation in which the US government alone in 2025 needs to refinance $9.5 trillion of expiring debt. Do you expect this is not going to have consequences on sectors that saw an incredible increase of direct leverage and synthetic leverage through the years, in particular, stocks and so on? Don't you think that eventual consequence in the stock market will see this liquidity moving out and then ending up somewhere else? Okay. So to conclude, it's clear that 2025 is going to be not an easy year at all to navigate. The following week, the earnings season of banks is going to begin. And I really think we are not going to see, that much, because banks, in the moment in which banks, they admit that there is no way they can recover all their losses that are hiding in the hold to maturity books, then it's game over. That is when the real panic is going to start, because, at the moment the whole system doesn't have a credit problem yet. The credit spreads are at ridiculously low levels. Real problems are going to start when credit spreads will begin to rise. So pay attention to that, because that will be the real moment that you might want to be out of risky asset, right? But before that, the animal spirit, they want to get rich quick and all, helped by all these liquidities sloshing around in the system, if you can position yourself ahead of time in order to intercept this liquidity entering into the next popular asset class, then you may really have some significant gains before it will be inevitably time to, run into cash. And cash, as you know, I mean T-bills, because bank deposits are not very safe if banks start going bananas. And then sit there waiting for everything to unfold, because then the next cycle, you need to be ready to buy when there will be blood in the street, do cherry picking, and take advantage for the next big cycle, while everyone else will really have to deal with significant problem from years of uncontrolled spending and speculation. With this, I conclude. Thanks a lot to everyone. Thanks a lot to my subscribers here on YouTube, on X, to my great follower that really give me a lot of motivation, and I really enjoy doing this hobby, and that also help me to learn more and more, and sometimes they stimulate me to do more and more research and to look into areas that I might have missed, that it could be treated better, and that are also helping me in becoming better in bringing all the relevant information to all the people out there that unfortunately they do rely to source of information like mainstream medias or some social that are frankly so dangerous, and these people are not going to be there to repay you for their mistakes down the road. Everything looks like honky-dory when everything goes up and everyone feels like an investment genius. But when there will be the moment that things are going to go back to normal, means the fundamentals are going to matter, the economies are going to matter, central banks are not going to print anymore and whatever, that's going to be painful for many that right now call themselves trader or investor or whatever, that in reality they might have just been very lucky